Great to have you on the show. Welcome.
Thanks for having me.
So you guys at Sequoia are sort of known at this point for some of the doomsday warnings and presentations that you've shared with your portfolio companies. I'm thinking back to 2008 and 2020 when you said the black swan of coronavirus. A few weeks ago, you called it a crucible moment. What does that mean? What do you think we're in store for here?
Well, look, the market is pretty tough right now. But the good news is tough times build strong companies. If we go all the way back to 1987, when Black Monday happened, it was only 8 weeks later that we got into business with Cisco Systems, which went on to basically lay the train tracks for the entire internet. Fast forward to 2008, 2009, after Lehman Brothers fell over, before the market bottomed out in the depth of the global financial crisis, we got into business with Airbnb at the seed stage. Fast forward then to April of 2020, 80% of Airbnb's bookings for the month got canceled because COVID had sent the world into a tailspin. Nobody was traveling. They knew what to do. They'd grown up in a tough time. So they quickly observed what was happening, came up with a plan, executed, and came out stronger than ever. And so tough times build strong companies. It's a terrible time for founders to try to get rich quick. It's a terrific time to go build an enduring business.
So what does that mean? Are you telling companies to slash costs, to slash hiring, to preserve cash? How are you changing the advice for this kind of environment?
So our advice is simple, but not easy. And what I mean by that is it is somewhat easy to understand, hard to execute. And the advice is go ahead and invest in your business, but don't just spend money. And there's a critical difference between the two. When you invest in your business, you're building an asset that's going to yield a future benefit. If you're just spending money, that's money out the door. So what does it mean to invest? Well, let's look at Snowflake. It wasn't the first cloud data platform, but it is certainly the best. Zoom wasn't the first video conferencing service, but it is certainly the best. Figma wasn't the first online creative suite, but it is certainly the best. So investing in your business means building a great product. Engineers, designers, data scientists, UX researchers, product managers. These are the people who are going to create competitive advantage over a longer period of time. This is where you want to keep investing. And oh, by the way, there are CEOs who are skeptical about the ROI of all these investments. Go use Amplitude to connect those dots, and you can see how what you're doing in product is going to lead to the financial outcomes you want.
So what does that say about what you think valuations right now for some of these companies that you've been in earlier are now public, like a Snowflake or an Okta or a Zoom Video? How do the valuations look right now?
You know, one of the things we've done over the last couple of months is launch the Sequoia Capital Fund. This is a structural change in our business, and I'll get around to why this is related to the question you asked. This makes us structurally long-term oriented. We have a single permanent capital vehicle that funds our entire operation in the US, Europe, and Latin America. What does that mean? It means that when we get into business with people like the Collison brothers in 2010 at the seed in Stripe and continue to invest throughout their life as a private company, we can keep doing that once they hit the public markets and be their partner for literally decades to come. And so to answer the question, in the context of a multi-decade time horizon, where we're trying to execute on the mission of helping the daring build legendary companies from idea to IPO and beyond, a few quarters worth of turbulence is just noise.